Welcome back. My name is Joshua Bellinger of CounterVest. Now, we know that having an edge is important in anything in life. Now, when you buy and hold stocks, typically that edge is the drift in the marketplace, meaning that how money is placed into the marketplace is that they're buying stocks, and that's how money continues to keep buying and buying and buying, and prices go higher. So that is an embedded edge in the stock market when you just buy and hold. Now, when it comes to trading, there's a lot of little edges that need to be stacked upon each other to create consistency overall. Oftentimes, many people say, Josh, I just want one approach. I just want the best approach to make money. Well, there's not just one approach. And oftentimes, you can have one approach that comes up maybe once a year, maybe twice a year, maybe once every 3 years that creates good returns. Now, that's great, but you have to, if you want to continuously make money and provide opportunities for yourself, you have to take little edges and stack them upon each other. So I'm going to show you one of my little edges here, and I'm going to explain to you why it's important and just an overlay or in context of why you just don't want to have one approach, that you have to have more than one approach. And when you have that, you can have different opportunities come in understanding the market in general. So let's take a look here at the SPY. Now, the SPY is just an index, and when we look at an index, indexes are manipulated. What they do is they take the best, they take stocks out that are underperforming and they put the best performing. So that's why indices look and continuously have this trend higher. But if we look at the stocks in general, we'll just take a look at Apple. Apple, what does it do? It goes up, comes back, goes up, comes back. So stocks and understanding products in general, indices trade differently than stocks. Options are going to trade differently than stocks as well because they're just different types of products. They're all different types of products, and having to understand of how to use these different, what we typically say are vehicles. Vehicles are, the end goal is to make money. What that vehicle is different products, options, futures, stocks, indexes, mutual funds, whatever it be. However, when we understand specifically stocks, we take a look here and we say, okay, stocks typically they're going to go up, they're going to go down, they're going to go up. So markets move higher, lower, and most of the time sideways and within a range. So we could take a look here, and we're just looking at a daily chart here. And, we got up, down, up, down, up, down, up, down. So, right now it's at new highs here, but in context here, this is why it's important to understand and look at the different edges and understand why one edge won't work with every edge. And the one edge I'm going to talk about here is that it triggered earlier here in this microchip technology. But the last time over the last 3 years, this trigger that I can back test, that I have found that performs specifically for this microchip, and it outlays other ones, but it's performed. And sometimes triggers or approaches, systematic approaches, perform better on certain stocks than other stocks. So you take a group when you're trying to get an analysis of it. You take the group, and you have some that perform better, and the other ones that don't, and you look at it as a whole and say, does this beat the market or underperform the marketplace? So you have some that are better than others, and this is a one that's a little bit better because over the last 3 years, this triggered about 8 times, 5 winners and 6 winners, 1 loss. So the average win on here on one contract was $188, and the average loss is $143. Those are important metrics because we want wins bigger than our losses. That's important because we want to have an edge. So one of the things that happened, and the reason why I brought up the SPY and also talked about stocks trading differently, because what's here on MCHP. We just look here at a daily chart over the last 6 months here. Up, down, up, down, up, down. Very choppy. But though that choppiness creates a range and also creates turns. The last time we had a turn was here on 519. Now, I'm not going to explain to you all the triggers because it is an edge. But one of the triggers is when you see here this turn here, the main ingredient, the main trigger here is this 50-day moving average. Stocks tend to hang around the 50-day moving average. So they deviate and they come back, they deviate and they come back. So, you can kind of get an oversold, pulls back, an overbought, pulls back, an oversold, and comes back into it. So it kind of hovers around there, and this is what we're kind of looking at. The second ingredient here is on the 19th. What happened here is that it shot through, it closed above that 10-day EMA. So there's a couple other triggers on here, but this is the most important. So within a day after this triggering, this closed out for a profit. And the most important thing, what we talk about is the three ingredients: thesis, trade structure, risk management. How are you going to manage risk? How are you going to manage winners? That's managing risk is managing winners. So on this trigger here, I did get an alert, but they did not cross, because right now we're below that 50-day EMA. Or, I'm sorry, we're below the 50-day simple moving average, but it did not get above that. It didn't close above the 10-day EMA. So this is one to keep an eye out for tomorrow. If this gets above and closes above that 10-day EMA, this is that trigger. So this alert came on my radar, but it wasn't a confirmation on this one. So what I'm looking for on this is to shoot through and shoot higher. Now, what I'm looking at here is that why these are so beneficial is because these are just kind of short-term, very bullish bursts. We're kind of looking for that turn. We get a momentum pushing it back up to that 50-day, and you're out. So short-term, inexpensive, mostly just gamma that we're buying because we're on a short-term time frame. So we're not buying time, we're just buying gamma and looking for that pop and then to get out. So on this one here, what I'm looking at tomorrow is I'm looking at the July contract here, and specifically at the 40 delta strike. So a bit of out of money, but not too far out of the money. Because again, if we get momentum, we can capture that, and we're not buying a lot of time, so the gamma benefits us on that short-term bursts. So we get fast pops in and out, and that's what we're looking for here. So looking at this one right here, it's at 150, 190, so mid-price theoretically at $1.70. What I'd be looking at on this one is a profit target of 40% of what I paid, and stopping out. It's important. Even though this does work, when it doesn't work, you want to have a stop. Now, stop out on this one is 60% of what I would pay, and those are the parameters I'm going to be looking at. What I've noticed is typically, you know, especially with options, you have these bid and ask. So you want to give a little bit of more cushion to a stop if you have a defined system. Typically, you know, typically it's tough to have stop losses on options because they are a derivative, and that's the trade-off. You know, they trade by nickels. This is 40 cents spread here. If you have a stop in, you're going to get probably get tripped up and get stopped out of it. So being that you have a kind of a trigger to alert you that you're at that 60% loss, and then you can execute the trade manually. So on this one, this is what I'd be looking at: $1.70, 40% profit, and a 60% loss. As I said, it just triggered 7 times in the last couple years. So last time being in May, this time coming up here right now. So that one, quick movement back up higher, kind of a bullish burst, and see that the momentum turn here, where again, looking back here, you know, we had this momentum push here, and then trade sideways, get a little bit of momentum, back, boom. So, you know, we did deviate from this one, this 50-day moving average, but it's been hanging around here ever so slightly. So that's what I'm looking at for this one. And this is, you know, how you create edges. It's not just one approach, but when you're alerted to it and you have a system, you follow the system. This is on my system. Let me know what you think, and leave a comment below, share it with a friend, and go to CounterVest and sign up for the videos that I don't release here on YouTube. So take care, and I'll see you then.